So now we've come to the second portion, the second topic, credit. This class is for credit. So what is credit? Credit's an amount of money lent by a bank or business for repayment in the future. So it costs, they lend you money, but of course they're going to charge you interest on that money. And so most interest rates are stated as an annual percentage rate. Annual percentage rate is an APR. Now, APR, annual percentage rate, is something as you borrow money for a car, home, loan, credit card, student loan, you have to become very familiar with your APR. APR is very important to knowing how much money you're really going to have to pay back in the future. Okay, next slide. So how do you get credit? Well, credit's built over time. It can be established by opening a savings or checking account and carefully managing it. Another way to have credit is getting a small loan, but one of the first ways that helps is opening a savings or checking account. But you have to manage those accounts, even though they're not like a credit card or anything. If you mismanage your savings or your checking account, it could actually really affect your credit score. And credit score is something we'll talk about, I think, in the next slide. Next slide. Okay. So good credit, making your payments on time, not exceeding your credit limits. If you have a credit card, every credit card except the black card comes with a limit, $500, $1,000, $2,000, what have you. People that look at credit, right? Banks, insurance company, landlords, employers. Banks, like if you're applying for a home or a car loan, they want to check your credit, see how well you've been repaying people. And also employers, right? Employers. Now, they're not going to be lending you money, but they look at your credit history because they want to see how responsible you are, right? So if they're going to be entrusting you to manage large projects with, due dates and large amounts of money, you can't have a credit history that shows that you can't handle large amounts of money and that you don't pay people on time. The things just don't go together, right? Okay, next slide. So your credit information, there's 3 credit bureaus in the United States: TransUnion, Equifax, and Experian. And one thing all of us can do, or all of you because I've already done it, every year you can get a free credit report to see what's on your credit. This website right here, www.annualcreditreport.com. Every year you can go there and get a free credit report and see what's been listed on your credit. Now, it's important to do this because sometimes there are items that are mistaken on your credit report and can negatively affect your credit score. This actually just happened to my wife and I when we were trying to get a mortgage for a house. I checked my credit and I found out there was a bill on there, a past due bill, negatively affecting my score that was actually not even my bill. So what I had to do, I had to go and petition these 3 organizations, TransUnion, Equifax, and Experian, that, this is an error. I never went to this place. I don't know how they, mistakenly gave, me this kind of bill or whatever. And that was able to be removed from my credit report. Credit score went up from that. And, that really helped with our the mortgage we were able to get for our house. So everyone, sometime after the conference, please check this once a year, annualcreditreport.com. Make sure there's nothing erroneous on your credit report. Next slide. So you've often heard credit score. I've just said that a couple times. So what is a credit score or a FICO? It's a scoring system developed by the Fair Isaac Corporation, ranging from 300 at the bottom to 850 at the top, where a score above 700, if your credit score is above 700, that's really good. If it's below 600 in the 500s or 400 range, it means there's probably some room for improvement, right? And the thing that's important there, and we'll see that in a little bit of slide later, if you have a lower credit score, when people loan you money, they're going to charge you a higher interest rate. And that interest rate takes away money that you could have used for something else, right? So it's an opportunity cost, right? If you're paying like $1,000 in interest, that's $1,000 you could have used on something else, invested or bought something you really wanted, but instead of that, you're using it on interest, which only pays the bank or the credit card company or whoever loaned you the money. So the factors are your payment history, how much you owe, the length of credit. Your payment history is, are you paying on time every month? How much you owe. Let's say you have a credit card with a limit of like $2,000. If you owe right now $1,900 on that $2,000 limit, that's going to negatively affect your credit score. So if you're really high to the limit, that's going to be a detrimental factor against you. All right, next slide. So a loan is a type of credit that we're probably all familiar with. A loan is repaid with interest and equal periodic payments. All the money is given up front. That's an installment loan. Some examples are car loans, student loans, mortgage loans. Nothing wrong with a loan in your financial portfolio. I'm dealing with all 3 types of those loans right now. Nothing wrong with that as long as you're on top of it and managing your money well. There's nothing really to be overly concerned about it. It's just when it gets out of control and you don't know where your money's going, right? That's why you have a budget. That's when people kind of get stressed out. Next slide. So before taking out a loan, as I've said, you've got to consider, first you have to kind of consider your budget. Then you have to consider the amount borrowed. Are you comfortable with borrowing this much money? Some people feel different ways about debt. Some people having a large amount of debt really weighs on them, and they feel all stressed out, like, oh, every day I gotta pay this back. Oh my God. And that if that's the kind of person you are, borrowing a large amount of money is probably not for you, because that weight on you is going to kind of prevent you probably from being as successful as you could have been in whatever endeavor you're borrowing the money for in the first place, okay? So you got to really know who you are and how well you handle debt. The interest rate, your APR, annual percentage rate, I mean, lower the better, right? That's pretty basic. The fees charged, pay attention to the fees charged if you do have to take out a loan. That's a sneaky way that sometimes, especially on car loans, they try and sneak in these little fees that at first you'll think it's, hey, I got a great car loan, a great payment, but they've got these little fees in there that when you finally sign the deal, your car payment's a lot larger than you and the dealer initially talked about. And then he or she'll say, oh, well, it's this fee and that fee and this fee and the other fee and the other fee and this and that. And then, they'll just fee you to death. So before you sign anything, make sure you have a conversation about any of the processing fees or origination fees or closing fees, fees on any of the fees with a loan, okay? Next slide. So here's a basic example of an installment loan. Let's say Anna borrowed $10,000 to buy a new car. If the loan is repaid over 24 months, the monthly payment, including interest, is $450. If the loan is repaid over 48 months, the payment is $245. Okay? Pretty basic, right? We all understand that. Next slide. So as you can see, paying over 48 months, obviously it's a lower rate, right? But it's going to cost Anna more. So it's going to cost her $960 more than paying over 24 months at a higher payment per month. So that $960, that's the opportunity cost, right, of taking the loan out over a longer period of time. That $960, if she had paid the shorter amount with the higher payment, would be something she could have used, invested, or bought something else. But so she's got a $960 opportunity cost for this loan. Now, there's nothing wrong with the 48-month loan. It's just that she would have to realize what her budget is, what she can comfortably pay each month, and then also realize that she's losing out on that $960, the opportunity cost of borrowing over a longer time. But there's no right or wrong answer. It's just what's best for you and your budget and your situation and your comfort level, okay? All right, next slide. So if I think this is kind of a high school, college age class. So what I wanted to post were some of the interest rates associated with different types of student loans. So what's actually great is these are a little bit lower than when I was in school, when I was in college. They've gone down. The most recent year, 2015, 2016, for your direct or subsidized loan that has to be paid back at a 4.29% interest rate. Also, the direct unsubsidized loan is also at 4.29, so that's great. With student loans, one of the new features since I've been in school, there's different payment options. And the payment options for your student loan isn't something you want to just start thinking about, you know, when you get about a month or so away from graduation, right? That's a conversation you want to have with someone in the financial aid office when you start taking out the loans, right? Begin with the end in mind. Think about how you're going to be paying this back in the future earlier than later, right? That way you can put a strategy together that'll be best for your budget and your situation. Okay, next slide. So credit cards. We all know what credit cards are. Plastic card allows you to borrow money, with a limit. You have to pay back whatever you borrow, at least making a minimum payment every month. That's the basics of a credit card. Next slide. So, minimum balance has to be paid. Interest, your APR annual percentage rate. That's something important to realize when you have a credit card. And the way you figure that out of how much you're going to be paying each month, you take the APR they give you, which is the annual percentage rate, and you divide that by 12. So that number, like if it was, let's say, an average rate for a credit card could be like around 18%. Right? If you divide 18% by 12, you get 1.5%. So you know each month your balance, you're going to be paying 1.5% interest on that every month. Okay, next slide. Oh, right. So here's an example. So at an APR of 18%, if you were to borrow something or have a balance on your credit card of $2,000, and you were just making those minimum payments that, you know, that's all you have to do, you would be paying $20 a month for the next 18 years, right? 18 years at $20 a month. So that original $2,000, whatever you bought, would have to be paid back at $5,500. So in that transaction, you're losing, or you're financing $3,500. So there's an opportunity cost to that $3,500. You could have used that money to buy something else, invest, start a business, what have you. So it's always important, and I'll sound like a broken record, to keep the opportunity cost of money in mind. Next slide. So in this example, we're talking about buying an iPod. You can look, Darnell, it's a $250 iPod. This might be a little bit dated. But at any rate, so you can see here by making a larger than the monthly payment of paying $80 a month versus the 20, he only has to make 4 payments, and that comes to about his iPod would come to about $255 instead of the $250. So that's a pretty wise use of credit, right? Only $5 extra in the finance, so we could have it now. That's pretty good. Next slide. So this is a slide that shows if the same guy, Darnell, was making $20 a month payments, you can see there's a lot more than 4 payments. There might be 10 or 12 payments altogether of $20 each. And so that original $250 that he borrowed to buy the iPod, now he's paying back at that 1.5% per month we talked about. He's paying back that's about $275. So he's having to finance 5 times more money over the $5 if he had been making a larger payment. So again, that's the opportunity cost of borrowing money. Next slide. So one of the things to be careful about with credit cards, as we just saw in that example, is only making the minimum payment. The minimum payment will keep you paying money for the maximum amount of time. That's a good way to think about it. The minimum payment will allow you to will keep you paying money for the maximum amount of time. And you never want to go over your credit limit. They'll give you a limit of $500 or $1,000 or $2,000 or $5,000 on a particular card. But for some reason, some cards have the ability to charge over your limit. And so if you go over your limit and you have like an 18% or 15% rate, which we talked about in one of the previous slides, going over the limit puts a penalty on your card. So instead of paying 15 and 18%, now you'll be paying 25 or 30%, right, to borrow money. So that's a huge difference. Next slide. So some of the things to be careful of if you go off to school with your credit card is not a substitute for an emergency fund, right? One of the ways we build our emergency fund is through our budgeting. If we're spending less than we take in each month, then we have a little bit over. And the first thing we do with any savings is put it away for a rainy day fund, because our credit cards are not a substitute for an emergency fund. Not to impress people. Credit cards can get you in trouble for trying to impress people. If you're a young man and you're trying to date a young lady, and you're trying to date on credit cards, and you're taking her out to crustaceans, and you're buying the red bottoms, and you're doing this and that, okay, I mean, you can do all that, but that's creating an expectation of, that kind of dating life, right? So it's going to be hard to go from crustaceans to McDonald's, right? That's gonna be hard to do. So also, you want to know your interest rate, like I talked about before with the APR. Always, you have to know the interest rate for the money that you're borrowing.